All right. So just quickly, a lot of moms on the call. So we want to wish everyone a belated happy Mother's Day. I got to do a nice Zoom call with my mom and family. So that was really nice. In some other good news, I have a haircut scheduled for Tuesday of next week. I know the gentlemen at the office have been giving me a hard time. Many of you on the call have been writing back on my, the little Monday weekly emails that we send out saying that I need to take care of this mullet, which I'm in agreement. And yeah, so Tuesday, looks like we get maybe one more Monday video of this this mop, and I'll be out of my college days again. Value of rebalancing. So I'm going to try to probably keep this one a little bit shorter than the one we did on the study of declining markets a couple weeks ago. I've got to give a lot of credit where credit's due in terms of rebalancing research. Of course, there's been a number of studies over the years, and a gentleman by the name of Michael Kitces, who writes a blog called the Nerd's Eye View. He's just done a really a nice job of summarizing different research reports and compiling them in a way that advisors like us and helps us understand things and gives us ideas and the best way to implement these in rebalancing ideas in the portfolios that we manage. So definitely want to give credit to Michael Kitces and his team. And you'll see as we go through some of these studies throughout the slides here, you'll see him referenced at the bottom. You should have a little Q&A button, I believe, down at the bottom. All right, so feel free as we're going through this webinar. If you think of a question, just put it in there right when you think of it, and then we probably won't address those questions to the end, but yeah, feel free to put it in at any time, and hopefully we'll be able to get to some of the questions. Hopefully all of them. We'll see. All right, so first slide, just a quick disclaimer. Through this webinar, Oceanside Advisors does not render or offer to render personalized investment or tax advice. Information provided is for informational purposes only and does not constitute financial, tax, or legal advice. Of course, we would be happy to give you this advice, and many of the people on this call, we do give this advice, but we need to get to know you better in order to do this in a fiduciary capacity. So, any questions, we personally, where we can put together a plan and so forth, we would be happy to do that. All right, so the value of rebalancing. Just kind of in summary, there's two big points here. The first one's in the long term. Why do we rebalance? We want to keep a portfolio allocated at the appropriate level of risk. All right, we'll touch on that a little bit more shortly. And then shorter term, the reason we rebalance portfolios, we're just looking for those opportunities to potentially generate higher returns. For those statisticians out there, this occurs through mean reversion, and you'll see what we mean by that in a little bit as well. All right, so I thought it might be a good place to start. For those of you that tuned in a couple weeks ago, we did a study on declining markets. Okay, we did this study on declining markets, and one of the actionable items was rebalancing, and I gave this this exact same example, and the guys in my ear were making fun of my artwork, so I thought this would be a good place to start, because this is a good example here. So maintain proper allocation through risk management. All right, and so risk management, this is this trade-off between stocks and non-risk assets. All right, so you know, a lot of times you'll see stocks versus bonds, but really we think of it, you know, there's a lot more non-risk assets than just bonds, right? You have cash, you have money market accounts, there's all different kinds of bonds. You have, you know, even like fixed annuities, something like that would be, you know, put in this bucket. But basically you have stocks, risk assets versus non-risk assets. And, you know, in the example that we gave a couple weeks ago, you know, we have this $1 million, you know, portfolio, 50-50. All right. So that just means 50% equities, 50%, again, non-risk asset or fixed income. Some might refer to that as. And I want to start on just one important point here. And that is, this might be the most important point, even much more so than any kind of rebalancing that we're going to go over. And that is, you need to start by figuring out what your ideal, your target asset allocation is. Okay, so in the example we're going to go over here in a minute, this is 50-50. All right, so half and half. But this ratio, it's going to be different for everyone. Okay, so and this is why we really encourage people to have detailed retirement plans, because this is where, you know, we get to know someone. We look at your liquidity needs, you know, how much you need out of your accounts, in what years do you need money out of your accounts, how much risk are you willing to tolerate, and we kind of compile all that information, and we develop these target asset allocations, right, that we think are going to give you the best chance for retirement success and a nice retirement that you feel comfortable with. And so, you know, so 50-50, yeah, this is with the retirees we help. This tends to be, you know, pretty common. We would consider this kind of moderate conservative, this range, but certainly for some people that it's far more equity. For others, it's much less. I would say it's, you almost always certainly want to have some equity exposure. Okay, even in the most conservative of plans, right? So even if you're not withdrawing money out of your equities at all at the moment, like inflation and life gets more expensive, right? So we have no idea what groceries are going to cost in 20 years. We don't know what healthcare is going to cost in 20 years. And so, you know, so sometimes we, you know, occasionally run into a situation where, you know, people don't really want to invest anything. And you know, that's why developing a target allocation that's going to be best for your retirement is important to figure out first. Okay, so once you have this target allocation, so we have 50-50 stocks to bonds. See, I told you this was going to be better than the my hand artwork a couple weeks ago. So we have 500,000 in stocks and in non-risk assets. Okay, now again, just like the example we did a couple weeks ago, here we have, we're going to show a market crash. All right, so of course we know what happens when markets crash sometimes. This is a bad crash, of course, but stocks are shrinking. From this $500,000 in equity has unfortunately turned into 250,000 of stocks here. Now, we call this portfolio drift, right? So we started again at that target asset allocation. We figured out that, you know, we thought this individual, this investor, this retiree, that the best chance for their retirement plan, we need a 50-50 allocation. And now through this market crash, the portfolio has drifted, you know, no action's been taken, but this portfolio has drifted from what was originally a 50-50 allocation to, you know, we're 33% stocks, right? 250, you know, with still 500 sitting in the non-risk assets. Many investors did not address this problem. Okay, this is a problem. This if it's not addressed many times, you could leave a lot of money on the table. Maybe to the point where you don't even get to achieve, you know, part of your retirement that you wanted to. So we would encourage you, do not be one of them. All right. This is why you rebalance. All right. So what we're going to do, we're going to show two different investors that are in this exact same situation. So Mr. Jones takes no action rebalancing. All right. So he has the 250,000 and 500,000 non-risk. Mrs. Johnson, now keep in mind, they're both starting off, right, the exact same situation, that they both experienced this exact same market crash where their stocks have declined 50%. The difference here is Mrs. Johnson works with an advisor that rebalances her portfolio back to 50-50. All right, so what's that going to look like when we rebalance? We're just trying to get things back to the target allocation, right? So that would mean we're going to sell a portion of the non-risk assets, and we're going to add to equities after they've declined in value. All right, so some pretty quick math. We no longer have 250 and 500. We're splitting that $750,000 portfolio evenly down the middle. So 375,000 in both stocks and non-risk assets. All right, so now if you were on the call a couple weeks ago again on declining markets, we've seen how there is a lot of evidence, a lot of history behind it. Markets tend to rebound, and many times they rebound significantly after market declines. Okay, so again, for the purpose of this hypothetical example, let's just say over the next few years, the stock market goes up 80%. All right, so not in 1 year, of course, that'd be a lot, but over a few years, that's very reasonable after a significant market decline. So let's start with Mr. Jones, who has not rebalanced at all. All right, so his $250,000 in stocks, as that rises 80% over the next few years, 80% on top of 250, that sends that equity allocation to 450,000. All right, so of course, combined, you put that with his non-risk assets, his portfolio is at 950,000. All right, now Mrs. Johnson, again, remember, rebalanced. So now she's back to 50-50. And so her base equity amount, right? So instead of 250 that Mr. Jones had, Mrs. Johnson has rebalanced up to 375 before this market rebound occurs. So starting with a bigger number, of course, that's going to help, right? So 80% on top of 375,000. She's up to $675,000 worth of equities. Okay, so her portfolio balance, 1,050,000, right? So in other words, this hypothetical example, but in the real world, this kind of thing happens all the time. The investor who properly rebalanced to maintain their target allocation has $100,000 more than the investor that took no action. Okay, now important to point out here, like rebalancing works both ways, right? So you better believe it. Like if we're helping Mrs. Johnson right here, after this, like we're rebalancing again here, right? Like we're not going to let this, because again, now we're off the target allocation just on the high side, right? So this $1,050,000 portfolio, like we're splitting this 50-50 again, right? 550 aside. And now, like sometimes I'll get the question, Johann, like we know that stocks go up, more than non-risk assets. Like, you know, Mrs. Johnson seems to be, you know, in a pretty good spot here. Like, why wouldn't we let this account just, you know, keep on growing? Why wouldn't we let these, you know, stocks just keep on growing and get bigger and bigger? And so the reason behind that is rarely do we come across an investor or a client that we're helping that their primary objective is to pass away as the richest person in the world. All right. We don't see that very often. Much more often, the people that we are helping tend to be that they want to live comfortable lives in retirement and feel secure, feel like they have balanced portfolios, where, you know, where if we can mitigate some of that volatility. And so, you know, that's why, like, yes, by rebalancing this yellow equity position, this bigger equity position at this point, are we likely reducing the return longer term of this portfolio? Like, yes, in this case, but that's a trade-off that most of the people that we help in retirement want to take. Probably have a question on that in a little bit here. Okay, so another question we get rather frequently: how often should I rebalance? All right, so you can see in, like, especially in a lot of like 401k plans, like you sign in, and usually, you know, you'll set your beneficiaries, and then like one of the next few questions they'll ask is, you know, how often do you want to rebalance? Like annually, quarterly, monthly? And so there's been quite a bit of research on this. Vanguard did a really nice study back in 2010. All right, and I'm just going to show you the results here, and I'm going to, oh, this is dangerous. I'm getting out the pen for the first time here. All right, so what they did, so this is a study that Vanguard put together in 2010, and what they were looking at was they studied a 60-40 portfolio, right? So 60% equities, 40% fixed income, and they went all the way back to 1926. All right, so the paper was released in 2010, so they were probably looking at data up till, you know, 2008 or 9. And so where's my pen? Oh, there it is. Let's erase that. Okay, so first thing, you know, we won't spend a lot of time on this, but annual turnover, right? That just means like how many positions are being changed, and of course intuitively, right? If you're rebalancing monthly instead of annually, like you would expect a higher amount of turnover, and that's a problem just from in a non-qualified account from a tax standpoint. You know, that you're going to be creating more tax liabilities than you probably want. But of course, you know, number of rebalancing events, right? So of course, you know, monthly, that's going to be a lot. Quarterly, less. Annually, you know, again, it's just 80 some years that they were looking at for this study. Here are the two important pieces, right? So the two most important pieces of portfolio management: what are the returns, and volatility, right? So this is a risk management variable. So as you'll notice here in the study, like 8.5% return with monthly rebalancing, and look at this, even slightly more, 8.6 for quarterly and annually. In other words, no benefit to return. Volatility, yeah, basically the same. Okay. All right. So what did they conclude in this rebalancing study? Well, the correct conclusion: study found that more frequent rebalancing produces no material benefit to returns or risk management. Okay, zero benefit at all. All right, so then, you know, is there a better way to rebalance? And of course the answer is yes, or we wouldn't be taking up 45 minutes of our Thursday going over this, but yes, there is a much better way to rebalance, and the answer is using what's called relative tolerance bands. Okay. All right, so tolerance bands. Instead of using time intervals, which we just showed doesn't do you any good at all, rebalancing should be based on relative price movements. All right, so rebalance based on how overweight or underweight a position has become relative to others in the portfolio. And I thought this was, they did a nice job of showing the way this works. If you're doing it properly, I'm going to get the pen out again here. Hopefully I don't lose where the mouse is. Okay, so again, example here is just like the first example that we went over. We're saying it's a 50% equity target. All right, and then we're going to use these what's called tolerance bands, and in this case we're going to use 20% relative tolerance bands. So the way to visualize this, right? So this is a chart, or this is going to show our equity allocation through time, okay, of a portfolio. So of course here's 50%. So this is the midpoint. So say, again, we sit down with someone or a couple and we spend a lot of time figuring out their target asset allocation. And again, just like the first example, okay, we want 50%. 50% equity is going to give you the best chance for success long term. Well, we know in the real world that markets are going to move, right? So we're starting right here, day one. Markets are going to move, right? So in this case, you can see the equity exposure getting lower and lower, right? So this most of the time, of course, means that stocks are declining in value, although it could mean that it could mean that bonds are actually appreciating, unlikely, but that bonds are actually increasing in value tremendously and equities are relatively flat. Okay, but more times than not, when you see this, it is stocks are falling, right? So stocks are falling down. All right, and then what you'll notice is see these little dotted lines, and hopefully you can see this on your screens. Maybe not if you're watching on a phone, but these are called tolerance bands. All right, so you'll notice right up here at 60%, we have an upper limit. You can kind of think of it as a limit. So we have an upper limit tolerance band, and then we also have them down on the bottom. Right, so this is why we're back to this 20%, right? So 50% is our target. We'll let it drift, 20% higher, which is the tolerance band at 60%. And same thing moving lower, right down at 40%, we're going to have a floor limit on where we will let this target allocation drift. Okay, so in this case, of course, it looks like the market's probably trending lower, and then it's going to break through that threshold, right? And this is going to put a bunch of red dots on my screen. I'm going to get flashing lights on my screen, and it's going to say, hey, there's an account that we manage that just broke a tolerance band. Okay, and so what we do when a position has broken its tolerance band, that means we are likely going to be selling some kind of risk-free asset, and we're going to be buying some more of this to get it back in target, right? So we want to bring this back to that 50% allocation. So you can kind of, this is really close to what was shown on that first slide a little bit earlier. Of course, in that example, they let this drift further down without a tolerance band, but same idea, right? So equities are falling. Hey, let's rebalance, because we know rebounds likely come shortly after market declines, right? And so that's the case here, right? So in this example, we're back to 50. We're in a position where if the market rebounds, the portfolio is going to be in a better position for that. All right, and then here we have, again, markets never move in a straight line, but markets trend higher, and before you know it, hey, here we are. We're on the upper limit of this tolerance band. All right, so this is going to signal, hey, this moderate conservative account with 50% equity, this has become too aggressive. This has become too aggressive. So in this case, we would be selling equity. Let's bring it back to target. Right, back to target. And so, the one important, caveat to throw out there is we need to be, and of course we are, but you need to be cognizant of whether this account is like a qualified account, for example, like an IRA, 401k, 403b, any kind of tax exempt. We don't have to give any consideration whatsoever to taxes. All right, a little more thought and analysis needs to be done if this were a non-qualified account, right? Especially up here, right? Down here, we might be tax loss harvesting. We might be selling losers down here. Whereas up here, we need to be a little bit more aware of a gain that we're recognizing. So that's important to bring up. Oh, one last point. One last point. I'm going to clear this because I drew all over the. Okay, so last point would be like the amount of time, like this from here to when it hits a tolerance band. Just an important point. Like this might take 3 years. This might take 3 months, 3 weeks, 3 days. Okay, like. And it makes no difference to us because as you saw, like the previous slide, time plays zero, well, close to zero. I guess the exception again is taxes, right? So if we want to make sure we're holding a winner at least a year, but for the most part, in terms of rebalancing, like time means very, very little. So in other words, some years with a lot of volatility, like we've had in 2020 here, like we'll be rebalancing more often, right? Because allocations are going to be moving all over. And a lot of other years, like 2019, we did almost zero rebalancing, right? Because everything just kind of moved up together. Both like stocks and bonds all did like pretty well. So we did like very little trading in 2019. And the evidence shows like that this is the way you need to be doing to be rebalancing to benefit yourself. All right, of course, thus far we've gone over some pretty simple examples. In practice, of course, portfolios often hold more than 2 positions, and that makes rebalancing far more complex. And I thought it would be worth showing you what this looks like on our screen, every day for each account that we help manage. All right, so this is a real portfolio. This is actually a real client, and now we manage a lot of different accounts, right? Like in terms of different models, right? So we have 50 or 60 different models based on how aggressive or how conservative the target allocation is. Do we need to be tax efficient? Or do we not need to give any concern to taxes if it's in like an IRA or Roth IRA? So all these models are different, but this is what it looks like, okay? And so, for example, instead of just one big equity position, again, this is the way it actually looks. So like each of these are different positions. And the difference here is we're kind of flipping the axis a little bit. Like the target, when we start a portfolio, everything is right here in the middle, right? So everything starts off. So there's a midline right here that is the target allocation for any portfolio that we manage. But you can see what happens, right? Like different positions go up, others go down, or not even necessarily going down, but maybe they're not going up as quickly as something else. So for example, like this position right here is a fund made up of a bunch of US large cap growth companies, right? We know that that pocket of the market has done really, really well in the last couple of years. So this is your, Amazon, Apple, Microsoft, Facebook, Google, Netflix, like that whole group. And not surprisingly, like this is the one that's pushing this upper tolerance limit the closest today. All right. Now, because momentum does play a role in returns, like that's why we want to let them run a little bit. Okay. That's why we don't set these tolerance bands, really tight, just a couple percentage points. Like you do want to let positions run when things are going well. Like there is evidence to that. So the tolerance bands that we use, oh, the guys are going to make fun of me again from our artwork. And they're, Patrick said that's good. This one might not be. Oh, let's see. Yeah, not bad. Okay, so, and this is another topic that's been, of course, researched extensively. Like, right, we all know that rebalancing is important, but like, where do you set these bands, right? And there's been all kinds of studies on this. And this is where, at the moment, like this is what most research suggests is the most beneficial way of doing it. Of course, we're always, looking at new data and always trying to get better and figure out, how, if we can improve anything in the process. But the way we do it is we'll let positions drift 20% on the upside, okay, and 17% on the downside. All right, and an obvious question that we get is why? Why do you let it drift further on one side than the other? And so of course this is called an asymmetric tolerance band, right? So we let one side get much heavier than the other. And the basic reason for this is markets go higher more often than they go lower. All right, so if you think about it, like as markets are going higher, we've seen through the previous decade, like markets will really run. You might go a couple 100% in a bull market, whereas bear markets, they can be nasty. You might be down 50, 60% in a really bad one. But point being, like markets go higher more than they go lower. So therefore, especially on like the downside, if you look at history, like there's a lot of periods of time where a position will start declining, and if our downside was 20% over here instead, it wouldn't reach that lower limit threshold to target a rebalance, and to bring it back to target. And so what ends up happening is on that downside, if the band is out at 20, the research suggests that that rebound might happen before it ever hits that band. Right, so that's the reason for the asymmetric tolerance band. 20% on the top, 17% on the bottom. And of course, you'll notice, the other thing you might notice, like some of these bands are bigger than others. Okay, the main reason for that is certain target positions are bigger than others, right? So like in this case, the US large cap growth, like we want this fund to be a larger, a bigger component of this portfolio than, gold, or this is the Vanguard REIT, real estate investment trust. Like, so each portfolio is going to have different target allocations. It's going to have tolerance bands that are, now they're all going to be 20%, 17, but that's going to be a different amount based on the position size. Okay, so again, this is real client. This just popped up a couple days ago, so I thought this would be a good example. So again, this is a position that just, it broke the upper limit. So on our screen, this is what it looks like.
And when we sign it, or when I get on my login in the morning, like this is, we screen every account that we help with. Like and if any model has broken a tolerance band one way or another, like I'm going to get a signal and I'm going to go in and address that, right? So again, if it's in an IRA, it's really easy, right? We don't have to worry about taxes. Really easy decision. If it's a non-qualified account, of course, we need to do a little more analysis, but more times than not, when we see this equals you receiving one of these emails. All right, so your latest trade confirmation is available. All right, so that's TD Ameritrade. Most of you know we custody with both TD Ameritrade and Charles Schwab. So the Schwab one, of course, looks a little bit different, but we've been using TD Ameritrade for much longer. So I'm sure many of you have seen this email come through, and this is why, right? So a lot of times, well, not a lot of times, but sometimes we'll get a call and be like, what I got the trade confirmation, like what happened? And the answer I give up, we rebalanced, which probably until you watch this webinar might not mean much, but maybe now you might have a better understanding of what's going on. And I would say, like, in wrapping up here, in conclusion, proper rebalancing, so we're creating a systematic method of selling a portion. So again, we're not selling the whole thing or buying the whole, we want to keep things at target allocations. So we're selling a portion of positions that have become overweight and reallocating those proceeds to positions that have temporarily become underweight, or vice versa, right? You can look at it either way. Rebalancing allows investors to maintain their appropriate asset allocation as well as potentially increase returns. Rebalancing should occur when the whole study, like, rebalancing should only occur when signals are triggered from relative tolerance bands, never based on arbitrary lengths of time. And I would just say, rebalancing is so important, and it's one of those things that we help give guidance kind of on the side to a lot of people that manage their own investments, and this is the one piece that I think a lot of do-it-yourself investors really struggle with, and many times they don't do it all. Sadly, we even see some advisory groups that don't pay much attention to this either, but really important. And so I know this webinar has been a little bit more technical than the last one, so hopefully we still have all the attendees here, so we appreciate you taking the time. And I think Patrick has been looking at the questions, if he's here. And if you have some questions, just type them into the bottom of the Q&A section, and we will hopefully answer some of them.
You hear me all right?
I can.
Nice. We have 3 questions so far. Let's start with Mary. I think we answered this one, but it's freedom. Would I need to notify you of rebalancing, or is this an automatic action?
Yeah, good question, Mary. Yep. So we track all of this on our end. We have every account that we manage, we track this. So you can leave that one on us. Good question.
Good one from Tom. Regarding rebalancing, is it more important maintaining proper asset allocation or generating higher returns?
Oh, I like that question a lot. Really good question. So what is more important, maintaining proper asset allocation or trying to generate higher returns? I would definitely say that the former. So the first part of that. Maintaining your proper asset allocation, as I kind of alluded to earlier, is that can many times be the difference between living the retirement you want and maybe not being able to accomplish that. So making sure you have enough equity in the mix, or, you know, conversely, making sure you're not taking too much risk, like unnecessary risk to make your plan work. Whereas, you know, generating higher returns, we didn't touch on this, but the actual like mean reversion portion of it, most studies suggest like we can add like a little less than 1% of value each year, okay, based on kind of the more opportunistic rebalancing like throughout the year. So yeah, that's great. That's great to have another percentage of return each year, but far more important, I think anyone would, I would think most people would think, to be able to live the life you want to live. So really good question, Tom.
Good one from Susan. Is a recording of our previous webinar, The Study of Declining Markets, available anywhere to view now?
Yeah, it is.
That's a
yeah.
nice question right up on a tee for us.
Yeah. If you thought this one was okay, you can. And this is a credit to Patrick, but he we started on our website, oceansideadvisors.com. There's a little tab up at the top. I think it's the third to the left of the three tabs, and you can click webinars. And down at the bottom, you can view the webinar we did a couple weeks ago. And I would imagine, not sure what Patrick's day looks like the rest of today or tomorrow, but I would think that this webinar would probably be up there shortly as well.
Good one here from Doug. Why are you concerned with the upper limit if it is going up with profits?
Why are you concerned with the upper limit if it is going up with profits? Well, so this is a question of, it's more of an investment question than anything else. And it really, it kind of goes back to the original point, like that most of the people that we help, they're not trying to pass away. They're the richest people in the world. They want more balanced portfolios. Okay. And certainly if the position's working well, like we're going to let that run for a while, right? That's why we let that tolerance band go way out to 20%. And now keep in mind that that doesn't mean like that position's only going up 20%. That means it's going up 20% more than all the other relative positions, right? So if the whole market's going up, I mean, things really have to be outperforming significantly before those are being triggered. So, it's a good question, Doug. I think it's a decision we make just based on being prudent in managing investments for retirees.
Good one here from Chris. It's the last question we have for the time being. How can I address this within a 401k?
Oh, wow. Yeah. Well, Patrick, why don't you take this one? Patrick does, Patrick helps a lot of our clients with 401ks and even, companies with, help offer small, mid-sized businesses with 401k plans. Do you want to take this one?
Yeah, I can hop on this one. Throw a really complex question at me, or what seems like a simple question that ends up being complex. So generally speaking, a really hard thing to properly rebalance your 401k based on tolerance bands, given that the company or individual that's helping you with your 401k through your company isn't using tolerance bands. Most of them are going to rebalance annually or quarterly or semi-annually. And so that's problem one. Problem two is it depends on what you're in your 401k. So if you're in individual funds, obviously rebalancing is going to be, you could look, monthly or quarterly and try and make decisions based on that. If you're in a retirement target date fund, each individual mutual fund company is going to have different rules in the fund documents that say when they rebalance and why. So the short answer is it's really hard to do without working with a professional closely. The long answer is that we, kind of what I just said, and we probably have to sit down and look at your specific plan and help you out one-on-one with that.
Yeah, well, that's good answer, Patrick. Put you on the spot there. You weren't expecting that, but
Yeah.
So how do we do for time? We're coming up again a little bit longer than I thought. I thought I'd be able to keep this one a little bit shorter. The weather just been beautiful down here in Charleston. Hate to rub it in. I see some people we help more up north, but
we got one more gem here, Johann, from Scott. If you take one more question, with recent volatility, have you increased the tolerance bands?
Good question, Scott. No, we have not. Again, the reason for that's just a risk management decision. Again, it's the fact that the majority of the clients that we serve, we want to be prudent, and by widening tolerance bands because of increased volatility, really we're becoming more and more risky and kind of getting away from our process of managing moderate conservative portfolios for retirees most of the time. So we are not going change tolerance bands just based on market volatility. Really good question though. So with that, hopefully you enjoyed the 50 minutes or so here. Hopefully you found it useful. And again, we love educating. Education is such an important thing. And it's nice sharing a little bit more inside of what we do. And we always want people to understand why we do what we do, and why we feel that that's in your best interest, whether it's retirement planning or taxes or investments or all the different important components that make up retirements. So again, thank you for taking the time, and we're going to try to keep doing these. So not exactly sure what the next topic will be, but we'll probably put something together here in the next week or so, and we will be sure to let you know as soon as we have the next one scheduled. So again, belated happy Mother's Day, all the moms on the call, and we will talk to you soon. Thanks, everyone.